as I mentioned before, I doubt it's going to be soft because I think the margin landing is going to be hard. And if companies are willing to accept it and not lay off people, then the economy will not go into a recession. But I don't think that's going to be the case.
Welcome back to Library of Wealth. In a recent interview, Cathie Wood discusses her market prediction for the end of 2023 and gives her investment thesis for ARK's position in cryptocurrency. Wood says the market's narrative is one of cautious optimism, embracing the concept of a soft landing characterized by receding inflation and lowering interest rates. This market position seems to anticipate that the Federal Reserve will inevitably respond to the rapid decline in inflation rates, especially given Chairman Powell's use of the term restrictive in relation to monetary policy. However, Wood presents a counterpoint, suggesting that while a soft landing is plausible, a more challenging landing might be on the horizon. Cathie also characterizes Bitcoin as a novel asset class, noting recent developments with major players like BlackRock that propelled the cryptocurrency's price beyond $30,000. Despite a subsequent decrease to $29,000 in the days after, she picks up on a trend that hasn't been seen since 2020. Wood offers her prediction for the coming bull market and sees significant upside in the last part of the year, leading into the Bitcoin halving of 2024. Let's get into the latest interview with Cathie Wood, as she discusses the future of Bitcoin, investing, and the market's impact on cryptocurrencies and the global monetary system. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
So let's go on to markets now. What are they saying? Well, the equity market is buying into this soft landing, inflation coming down, interest rates coming down. It's looking over whatever the Fed is doing or saying now and is basically saying, hey, these inflation rates are coming down so rapidly that the Fed will have to follow them, especially now that Chairman Powell has used the word restrictive in terms of monetary policy. That is a setup. And as I mentioned before, I doubt it's going to be soft because I think the margin landing is going to be hard. And if companies are willing to accept it and not lay off people, then the economy will not go into a recession. But I don't think that's going to be the case. I do think they're going to cut labor because the full impact of monetary policy has yet to be felt. If it's an 18-month lag, up to an 18-month lag, we could be, given that the last rate increase was in the last 10 days, we could be experiencing the impact of tight monetary policy for the next 18 months. The fixed income markets are basically, the yields are moving up in response to a stronger than expected economy. So that real GDP growth number, and they're responding less to the lower than expected inflation. And we know there are a lot of traders positioned on both sides. Some believe that the interest rate, the long-term treasury yield, is going to break out from the base that we've been in since October. Well, the base is longer than that, for about a year and a half. Last October, we peaked at 4.34%. Yesterday, we got into, I think it was 413, 414. And today, Friday, employment report, weaker than expected. The yields have come back in. We see the yield curve also narrowing in terms of its inversion. We were at more than 100 basis points, and that was trouble here in March, and we had just gotten there again, and now we're at 75 basis points, more because long yields have gone up than short yields coming down. And the spreads, if you look at the corporate spreads, corporate yields relative to treasury yields, they're well behaved as well. They are not saying yet that margin pressures are going to be a problem, but we think they will. So we think those spreads, depending on the industry, will start moving up as the economy weakens. Commodity prices, if you look at the Bloomberg Commodity Price Index, it has gone from 140, that would have been in March of 22 when Russia declared war against Ukraine, and oil prices and food prices shot up. So we got up to 140 and are now down to 105. The downturn actually started in 2008 when oil prices peaked. We're down to 2005. But if you look at the base of the last, I'm going to say 40 years, we're still in a range. It's a wide range. But very recently, the trend has been down. And we don't think that trend will be broken. And then finally, Bitcoin, new asset class. After the excitement about BlackRock's ETF filing for Bitcoin in June, which rocketed Bitcoin beyond 30,000, it has come down a bit. It's around 29,000 now. And even more notable is the volatility has come down dramatically. In fact, we haven't seen this low of volatility since 2020, right before it embarked upon a major move. Sometimes volatility means that it's going to break down. So when there's very low volatility, you look for signs of, is this going to break out or is it going to break down? Given our on-chain analytics, we're on the bullish side. You'll see those signals. On balance, they're very positive. So the internals of the market, the on-chain analytics, are telling us that if there's going to be a break either way, it will be a breakout to the upside. And as you'll remember, the last highs were 70,000. And this has been a market that has been moving. It's been moving such that we have higher highs and higher lows with each cycle. It's very volatile, of course, as we all know, but higher highs and higher lows means we're in a secular bull market. And as far as anything else in the world of innovation, very exciting week, actually 10 days. There seemed to be a superconductor breakthrough, room temperature superconductor. And our chief futurist, Brett Winton, along with many others, said, this is probably fake. He gave it a 10% chance about a week ago of being the real deal, a real breakthrough. And we may not see commercialization of very much for quite a while. So if you're looking for a breakthrough in earnings based on this in the next year or so, no to that. But it might be bringing us much closer than even we thought to quantum computing, which would change everything. And we're doing a lot of research. Actually, our crypto team started doing the research on quantum computing because it's quite relevant to cryptography.
According to recent reports, Federal Reserve policymakers are preparing to raise interest rates this month and are open to the possibility of further increases later in the year. Despite a slight easing in price pressures last month, officials are cautious about declaring an end to their efforts to combat persistent inflation. The central bank aims to avoid repeating the mistake made in the 1970s, when premature easing of inflation control led to a resurgence of double-digit price increases. Federal Reserve Bank of San Francisco emphasized that it is too early to claim victory over inflation. However, investors have begun speculating that the expected quarter percentage point rate hike at the upcoming Fed meeting will mark the end of the current credit tightening cycle. These expectations have driven stock and bond prices higher, indicating market confidence in the Fed's intentions. What do you think about the latest interview with Cathie Wood? And what are your thoughts on her analysis of the market's response to inflation, interest rates, and the impact on Bitcoin and the cryptocurrency market? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.